8 times a year, 12 people walk into a room in Washington, D.C. They sit down, they talk for 2 days, and then they change the price of everything in America. Your mortgage, your car loan, your credit card interest, your rent, the cost of starting a business, the return on your savings, all of it. Set by 12 people in a room that you will never enter. This is the Federal Open Market Committee. Most people have heard of it. Very few understand what it actually does. The FOMC does not set prices directly. It sets one number, one single interest rate, called the federal funds rate, and that one number ripples through every corner of the American economy. Every loan, every investment, every business decision, every purchase made on credit, all of it is downstream of that one number. So if you want to understand why your mortgage costs what it costs, this is where you start. And if you want to understand who really runs the American economy, this is where you start too. So who are they? The FOMC has 12 voting members. 7 of them are the Board of Governors, appointed by the President and confirmed by the Senate. They serve 14-year terms, not 4 years, 14. This is by design. Long terms mean they are insulated from political pressure. They cannot be easily fired. They are not up for re-election. The remaining 5 voting members are presidents of regional Federal Reserve banks. The New York Fed president always votes. The other 4 rotate among the 11 remaining regional banks. These regional bank presidents are not appointed by the president. They are chosen by the banks themselves. That is worth sitting with for a moment. 5 of the 12 people setting American monetary policy are chosen by private banks, not elected, not publicly appointed, chosen by banks. The Fed was designed this way deliberately to keep monetary policy independent from politics. Whether that design has worked as intended is a question economists still argue about. But that is how the system is structured. So, what happens when these 12 people meet? They receive briefings, enormous amounts of data, inflation numbers, employment figures, GDP growth, global economic conditions, consumer spending, business investment, housing starts, all of it. Then they debate. What is happening in the economy right now? Where is it headed? What does the data say? After 2 days of discussion, they vote, and they set the federal funds rate. This is the interest rate that banks charge each other for overnight loans. That sounds obscure. It is not. Because every other interest rate in America is built on top of this one. When the Fed funds rate goes up by 0.5%, mortgage rates follow. Car loan rates follow. Credit card rates follow. Business loan rates follow. It is the foundation of the entire credit system. The Fed has 2 official goals, called the dual mandate, maximum employment and stable prices, which they define as about 2% inflation per year. When unemployment is high, they lower rates to stimulate borrowing and spending. When inflation is high, they raise rates to slow borrowing and cool prices. That is the theory. In practice, hitting both targets at the same time is nearly impossible. Fighting inflation means raising rates, which slows growth and kills jobs. Keeping unemployment low means keeping rates down, which risks inflation. Every FOMC meeting is a balancing act on a tightrope, with the entire American economy on one end. Let us make this concrete. In March 2022, the Fed began raising rates aggressively. In 12 months, the federal funds rate went from near 0 to over 5%, the fastest rate increase in 40 years. Here is what that meant for ordinary Americans. A 30-year mortgage at 3% became a 30-year mortgage at 7%. On a $400,000 home, that difference is roughly $1,000 more per month, every month, for 30 years. The same house, the same neighborhood, a completely different financial reality. Because 12 people voted to raise a number. Car loans went from 4% to 8%. Small business loans became prohibitively expensive. Startups could not raise money cheaply anymore. Tech companies laid off thousands of workers. SVB collapsed, as we covered in the last video. All of this traces back to one room. 12 people, 2 days of meetings, 8 times a year, and yet most Americans could not name a single FOMC member. Most could not explain what the federal funds rate is. The most powerful economic body in the country operates almost entirely outside of public awareness. Here is the question that makes economists uncomfortable. Who is the Fed actually accountable to? On paper, Congress. The Fed was created by Congress in 1913. Congress can technically change the Fed's mandate. Congress can audit the Fed. Congress can even abolish it. In practice, Congress almost never interferes with Fed decisions. Politicians on both sides have learned that blaming the Fed is useful. Taking responsibility for monetary policy is not. So the Fed operates with enormous independence, which means 12 people, some appointed by the president, some chosen by private banks, make decisions that affect every American's financial life without a public vote, without a ballot, without most people even knowing their names. Jerome Powell is the current Fed chair, but his face is not on campaign posters. His decisions are not debated at town halls. His policies affect more Americans more directly than almost any legislation Congress has passed in decades. And yet, the average American voter has almost no direct mechanism to influence those decisions. This is not a conspiracy. It is a design choice. The designers believe that monetary policy should be insulated from short-term political pressure. They may have been right, but it is worth knowing how the system actually works. Because understanding who holds the lever is the first step to understanding why the lever moves the way it does. 12 people, 8 meetings a year, one number. That sets the price of money for the entire American economy. Your mortgage, your savings, your job, your rent, all of it downstream of one room. So the next time you hear that the Fed raised rates or cut them, you now know what that actually means. And you know who decided it. Whether that system is the right one is a question worth asking. But you cannot ask the right questions until you understand how the system actually works. That is what Hidden Economy is for. Subscribe if you want to keep following the money, because the next video answers the question we left open at the end of video 3. Who benefits most from the way this system is designed? And the answer will change how you see everything.